Hello, everybody. Good evening from Cape Town, where the weather is certainly not 35 or 37 degrees. We would love to have that, but anyway, it's quite pleasant. Yeah, so we haven't had a fixed interest, what we call a fixed interest structured note for quite some time. Number of reasons for that. There've been a lot of other sectors that we've been looking at that are creating some great returns. And certainly the banks, generally, when you fix them to a guarantee, they get quite skittish. The lack of hair on Graham's head, well, he's got a pretty healthy head of hair at the moment, but he's been fighting to get this. And certainly, this is when it says fixed income on the screen, it means it's guaranteed, it's unconditional, it's irrespective, and Jill will deal with this in the second part of the presentation, which is the shorter part. It's unconditional, so it doesn't really depend on what the companies do, but it's important what the companies do for your capital. Okay, so it's in US dollars. Thanks to Idad and Graham for nailing down a really solid coupon. That equates to 12.55%. And as I mentioned, the banks get quite skittish because their finance team has basically said, we will unconditionally guarantee this payment on a quarterly basis. So what do we have to be concerned about? We have to be concerned about, is our capital going to be safe? Okay, because the income is going to be paid irrespective every quarter. So it's great. Bottom right-hand corner, as I always point out, is a bit of a health warning. We've got limited, there's two sort of caveats to this. We have a limited inventory that the bank gives us. In other words, the capacity in terms of what quantity we have available. And secondly, there is a fixed closing date, because obviously this has to start at a point in time. And whichever comes first, obviously that would then close off the issue. We do have a little bit of credit with BBVA. We haven't burnt all our matches with them because we've done a lot of work with them. And there is a little bit of room to shimmy on the upside and maybe get a few more bob out of them. But I would rather say, let's see what we've got on the table. It's a bit like going to the supermarket when the shelves are empty. There might be something in the back room, but there might not be. So if it's of interest, get your orders and your expressions of interest into Logan. Okay, so let's move along. And I thought I'd start with some thoughts about time and money, because time and money will crop up through this presentation, right the way through this presentation. And generally, we live in a space where these are two sort of commodities which we both value intensely. You should certainly. Going back to Benjamin Franklin, 1748, time is money. That's probably one of the most famous and used sort of mantras or quotes by financial services companies. I mean, if Benjamin Franklin was alive, he'd be making a fortune in royalties if he trademarked it. Such a thing exists back in 1748. But if you go around there, you can see the various people who, some are mentors, some are motivational coaches. One is a preacher, believe it or not. But it all basically says the two are interlinked. Time and money, they don't wait in terms of value. I like the one on the bottom left-hand corner, which basically is it's Chris Rice, who's basically an evangelical singer, believe it or not, in the States. And he says, we all start our day, whether you're a prince or a pauper, you start it with the same bank account, if you talk about a bank account. And in that bank account, the currency is time. And we all given the same amount of time. Just because you're rich don't mean you get more time, or poor you get less. But we all get 24 hours each to do something with it. How we employ that and how we make the best of that is what differentiates and what makes our purpose meaningful. And I think the other one on the right-hand side is pretty much relevant to us as self-led investors. Where do we sit? Okay, we are the pilots of our destiny in terms of, time flies, but as they say, we're the pilot of that particular plane. How do we manage that, and what do we put in at a certain time in our life to match the expectations that we need or the requirements that we need? So just some thoughts about time. You may have seen these before, but it'll keep cropping up in terms of where we're going. And you will remember that the first slide, you might not remember, but the first slide the title is an AI backbone. So artificial intelligence backbone. What on earth am I talking about now? So it's in this tech space. That's why I was talking earlier. Maybe Logan of a different millennial age should be leading this thing, as opposed to myself at 65 who battles to turn on my TV sometimes. So yeah, backbone. It's not quite anatomy 101, and you'll see something about hamstrings later. But fundamentally, on the right-hand side, a backbone is a foundational creation. It supports, it creates structure, and from that you derive strength. And yeah, we are part of the giraffe family there. That's what Jill chose to iconoclase us as, giraffes. We are mammals. And yes, we form part of the sort of vertebrate kingdom. So that's us. We have backbones, hopefully. In terms of the AI space, which we obviously in terms of this particular theme of this note, the underlying current is, linked to artificial intelligence and what it's producing is the core infrastructure. So there's huge amounts. There are a lot of parts, and there's a huge amount of information around artificial intelligence. We're not going into that tonight. We'll touch on it, but literally, it's the networking side. It's what makes things move. That's important. It's a sub theme. And figuratively, if you say to somebody, no, you haven't got backbone, that means you haven't got the proverbials to challenge or stand up or say something. So it's your foundational strength in terms of your moral direction, etc. So the key takeaways, when I looked at this slide, I thought, it's critical, it's crucial, it's core, the 3 C's. It's a crux in terms of, where you are going to next, okay, and the importance of that. So let's have a look at that word crucial. Okay, it's on the next slide, if we can go to that. And it represents a pivotal turning point. If I cast my mind back to my first year of study at university, because I hadn't studied it at school, I had to do Latin and crux. I always remember that. It means across. But it means, in terms of across, you've got 4 different points of exit or entry. It could mean a change of direction at very short notice. Again, time and speed. Again, okay. And certainly it's important because cruciality, and believe it or not, I use that and I picked, is it an actual word, and it is a noun, believe it or not. And I like to call it rather critical urgency, but let's call it cruciality or critical urgency. It's based on a number of factors that are decisive, essential, and are necessary for your enterprise to actually work when you make those decisions. So this is actually very real time, very quick, linked to a monetary payoff and linked to whether your business could go left or right in terms of this backbone working for you. So moving ahead, let's see. Okay, so what is this AI backbone? And it's massive. It's a massive piece of work to try and unravel. And we're not unraveling it because we're only a small component in terms of what we've identified as a team as a thematic approach to leveraging off the bigger, wider super trend or super mega theme of AI, artificial intelligence. So your first one, obviously, on the top left-hand side, it's broken down into the four components that you got there, the 4 blocks. The first one being the semiconductors and AI processors. That has been the absolute darling of the investment world for the last 12 to 18 months and pretty much into 2026 this year. The companies such as NVIDIA, AMD, Advanced Micro Devices, ASML in Holland, TSMC in South Korea, you name it, the big guys who are producing the chips, the semiconductors, the microprocessors, all those little things that go into the back of your TV, etc., and your computers and phones and everything, and make things work. That is where the narrative has laid, and that has driven markets, investment markets, in a very narrow field down the road in terms of dragging indices to these huge valuations and these very stretched valuations and almost records in terms of what those indices are now sitting at. And there's question marks now starting to appear. Those of you who follow us on the weekly wrap, you'll see consistently over probably the last, I would say 6 to 8 weeks, even longer maybe, there has been this sort of elephant in the room, is that the question about is the bubble, this AI bubble, is it a bubble? Will it explode? Will I get hurt, etc.? We'll do a little bit of that later because it's actually pertinent. Below, semiconductors and AI processors need a home, and they live in a data center. These data centers that have been built conscientiously and rapidly around the world. It's got to the position now where Elon Musk, for example, is even thinking of, and it was hyped in the IPO of SpaceX that he's going to start building data centers in space to get away from power and cooling on the bottom right-hand side, which costs a lot of money and a lot of infrastructure, a lot of time and speed of delivery, and harness the rays, not the rays, what do I call them? The word is escaping me at the moment. To literally to harness the microwave and electromagnetic. See, now you can see I'm not in my comfy space. Electromagnetic waves of powering power systems and power data centers from outer space. And basically saying, I don't need to be stuck on a terrestrial base like everybody else with their problems of labor and unions and tariffs, etc. So again, future thinking, time, speed, money. Where do we sit in this particular note? This particular note is sitting on the connectivity and transport highway. No, not trucks and buses and tubes and trains like Matt's just got off with no air conditioning. We're talking about networks, computer networks. We're talking about infrastructure networks that will release the AI. Otherwise, AI gets stuck in the data centers, becomes a prisoner. So that's pretty much where we are, where this particular note is in terms of a theme. So if we look at the particular companies, the reference companies that we've isolated and we've interrogated and we've included in this basket, that goes into the next note, please, Joel. Where do they sit in this ecosystem? Because obviously you've got the theme and you've got these various ecosystems that are generating those four themes: power, cooling, transport, this, that, the next thing. So where do we sit? We sit in this connectivity and transport layer, okay? And these particular companies, as I've said there, they don't generate they're not creating the generative AI models in terms of what ChatGPT and Gemini and DeepSeek and all those other models are producing. But what they do is they provide and you can read it for yourselves, the ultra-fast networks, secure data pipelines, routers, switches, cellular infrastructure, etc. They are carrying the load. In other words, they are the road on which these companies who are creating, the hyperscalers who are creating the AI payoffs, have to travel. They can't do it alone. There's the cloud, but there's also these particular mechanical functions that have to work in terms of networks. And I think that one little block there is actually quite important. And it came out of a Microsoft conference around about 18 months ago. So that was quite a long time. The world has changed dramatically. It's moved forward very, very quickly. But I think it still holds credibility that without this connectivity, AI is going to remain trapped in the data center. It needs to get out. So the graphic on the right-hand side is typically the inquiry. You're sitting there, ChatGPT, you're on your phone, you're asking inquiry, who's this guy talking to me or whatever, etc., etc. And there's the sort of the flow diagram in terms of that middle section has to exist. Okay, so it's a theme that's probably been undervalued by the investment market at the moment because it's been completely focused on, we are running short of data chips, we are running short of all these processes to create artificial intelligence, but it has to sit on something to ride, okay? And certainly these three particular companies, and there's many, but these three particular companies we've harnessed into the reference basket of this particular note. And as I mentioned, all we want to achieve is that these companies do not lose more than, I think it's 45% of their value. There's a 55% capital protection value. So in other words, at the end of the day, as long as they haven't degraded by more than 45%, which is almost like half of what they're worth, well, then there's a problem. Now you juxtapose that in terms of this powerful theme that's moving forward. Yes, companies go up and down. There's volatility every day. Nokia was down 8%, 7% on Thursday. It's up 9%, maybe 10% today. There's volatility in every company. But ultimately, the bottom line is that it connects to the foundation, and the deliverable is to you, the person sitting at home making an inquiry, the surgeon making an incision through a robotic, the answer that a car gets when it says short turn left or right if it's autonomous. And there's some real world applications that are really being rolled out. Not so much in Africa, I would say, because I think we're a little slow in terms of adoption or adaption. but certainly in many parts of the world, those 4 subsectors are themes in themselves in terms of that. I mean, my late father-in-law, who came over from New Zealand, I mean, he had robotic surgery. When he first came back to me, and he said, "I'm going to have robotic surgery." I said, "What? Some robot's going to perform something on you." He says, "No, the surgeon actually sits at a desk in the theater. Some of them sit in the office, and a robot, a surgical robot with certain training, will then, on his instruction, start doing the necessary incisions, suturing, removals, grating, grinding, all those medical terms." So it's amazing. We are moving really quickly. We thought after COVID, how our lives changed with things like Zoom that we are now, or all the technology that made our lives completely different. This is the next wave. It's happening. There's probably many of you on this call who may have been in a vehicle that's driverless, or I've seen these vacuum cleaners that run around people's houses. I nearly tripped on one the other day and spilt my beer on the way to the rugby. But I mean, it's happening, and the adaptation and the adoption is coming through. But it all works on the premise that it's going to work. Okay, and that's the interesting point. So let's move on to where does this all sit? And it sits in the computer backbone. Okay, so whether it's, and I'd rather perhaps should have called this a device backbone, because so much power emanates from a mobile phone as opposed to a laptop, as opposed to a tablet, as opposed to your desktop, etc. There's just so much computing power. And that is actually another huge trend. I mean, I keep talking about all these different trends. And so we spoil for choice, because computing now, in terms of the next level of computing, is going to be taken to the next level. But let's stay where we are. It's absolutely crucial. Then back to slide 5, I think it was, the word crux. We have to have these in place. Otherwise, speed and time is of the essence. It's, if you're in an autonomous driving car and the backbone of the network is not working, and it says, do I turn left or do I turn right, or a dog has run in front of me, or a ball has bounced in front of the car, what do I do? They're not pre-programmed. It's a very interesting slide we're going to look at next, or 1 or 2 down, which shows that the different evolution stages of how this proactive and reactive latency has existed. Now, latency is another word I had to learn and had to find out what it all meant. Latency is basically the speed of delivery. Again, there's speed, time. It's, you press your button on your computer saying send, I want to get an answer. How long does it take to come back? I was chatting to Chad, I think, until 2 or 3 days ago, and I said, remember the days where you were watching a video or a movie on your laptop? And maybe some of us are a little bit older than others, and the younger crowd won't remember this, but something used to come up on your laptop. It says buffering, and basically you had to sit there and wait. So that's the latent effect, in terms of there's a delay in terms of the answers, or the critical, crucial, pivotal answers coming through to you. So this is really what is so important. These particular companies are literally putting the network together. So you could be, to that almost that bottom line there, a backbone can tie so much together. You could start off in a house. It can be linked to a network of houses, or an office block, or a local area network, and a wide area network, and then the globe. It's that whole seminal effect of spreading and fluidity of information, and the speed of information. So these companies that we have chosen for this AI backbone are absolutely intrinsically crucial to make sure that the efficiencies of AI actually get delivered. That's the bottom line. And if we go to the next slide, we can see how we've changed. Okay. This was my attempt at trying to show how we've changed. So probably that might have been a Wells Fargo Gold carriage, or whatever it might be, or newspapers, or mail, or whatever, mail carriage, fighting its way across the Grand Canyon. And, superimposed over it is where we are currently, how the speed of how the connectivity around the globe actually works. The supercomputer, the superhighways of information. It would take weeks and weeks for a carriage to get over there, and the news would have been 3 or 4 weeks late. And by the time the carriage went back and retrieved the news and brought it back again, the world would have changed. So things have changed dramatically, and expectations have changed accordingly. If I hold that word, just expectations, and it comes back to this whole AI, back to my first comment about, is there a bubble in the room? Is there an elephant in the room with AI? Is it this over bloated narrative that we've all a lot of people invested in, and is it all going to go south? Expectations are very important, and I will deal with that. There's a great example of one of Nokia's, which is in this particular basket, one of their competitors, Samsung, which came out this week, and I'll address that then. It gives you a very live example of how people's expectations are now running ahead of things. So back to, what is, this artificial highway, and, what are we delivering? What does it have to deliver? And the first two blocks, not the orange blocks, the first two blocks, the ones above the line, those are kind of currently what's in place at the moment. That's what's being, employed, it's being developed, and it's being rolled out through these networks, through the cloud, through everything. So reactive machines are pretty much process-driven machines. You'll see those. They've been around for decades. Typically, you go to a automotive, BMW, Mercedes, Toyota, Ford factory, you'll see these robots. They know exactly what to do. Nothing changes. It's the same shape. It's the same thing. It's the same welds. It's the same amount of time. Boom, the doors go on, the car rolls on. So it's very much, it's been learned. It hasn't been taught to interpret. It just does a function. It's a functionary. Second block, top right hand, is pretty much where we are at the moment. It's all happening, and it's scary for some people. In terms of, wow, this is really powerful stuff. Will I be needed, etc.? That's one of the sort of concerns. But again, that's pretty much where we are at the moment. And the next two are really step changes in terms of possibly the power of artificial intelligence. And, you can read through them. I'm not going to sort of go through it in detail, but you can read through them. And essentially the bottom right-hand one is when the actual data inference and interface actually creates its own emotions and starts introspecting about, am I doing the right thing? Am I saying the right thing? And becoming almost human. So that's when the trainee becomes maybe the trainer, and that's where potentially, manipulation and concern and danger lies. So a lot of people have said that. I mean, Elon Musk, who is probably at the forefront of artificial intelligence, has expressed concern there. But it's that's what this backbone has to deliver. So the backbone has to be around. It can't just disappear and wither. It has to be literally part of our setup. So let's have a look at the next slide, which I've called Time is Money. I've spoken a bit about risk. I've spoken a bit about the elephant in the room being maybe this AI artificial bubble, and I think essentially what we're seeing at the moment is that we've got massive stretched valuations in companies that are linked primarily to AI, particularly the companies who produce the capacity, and that's an important word, the capacity of microprocessors, semiconductors, all those things that go into computing that makes it work. And capacity is important because if you don't have capacity, it becomes a supply problem, and a supply problem generates economies of scale, supply and demand. If there's not enough supply, then demand goes up and the prices go up. Okay, so a lot of people have been saying billions have been poured into AI, and which they have been. It's staggering. It really is jaw-dropping in terms of the amount of money that's being spent in terms of developing these models and developing everything. But as a shareholder in those companies, when's it actually going to pay me back some money? Okay, it's all very well the share price being elevated and the valuation being elevated, but is it real? Are other companies going to go and buy that model and use it in their business? Is it going to help them? So that's the primary headwind I think that most people are facing, is that this massive spending, and at the moment we are capitalizing on future profits which actually haven't been made yet. Okay, so then there's a question mark. Okay, they actually haven't been made. What happens if they're not made? What happens if these systems aren't adapted or adopted by other businesses, aren't bought? So I've broken it down into these sort of headwinds and the counter argument where this note actually works quite well, because we're not intrinsically in AI, but we're part of the ecosystem that will be affected by some of the, perhaps if there's a sharp reversal in some of the mainstream AI stream, it will affect. So you need to be aware of these things. I think the monetization gap is probably the most important. Spending billions and billions and billions, and what happens if people aren't adopting it? They're going to say, well, hang on, maybe we need to think about something else. That's why I think earnings are very important. I always harp on about earnings in all my webinars, in terms of a company's earnings are really important. It's all very well to have these massive revenues that you are earning from sales. But what are your earnings? What are your profits? What is your free cash flow? How much have you got left after you've paid all the bills and paid all the debt and the interest and the R&D, etc.? How much money have you actually got to spend on acquisitions or opportunities? Or if something comes along, which is a big, like, well, what do we do? Do you have a cash pile you can sit on? It's a bit like us as consumers. We spend. Something happens, interest rates goes up. Now, how are we going to afford the car we bought? Is there a buffer? Is there a cash box we can sit on? No, that's sorry, cash box. Is there a cash pile we can sit on and utilize? So it's very much like that. Big business, you can transport it and you can relate it to your day-to-day business. Aggressive valuation multiples. That's happened all over the place. The companies we've chosen haven't gone stratospheric. We're not sitting like a SpaceX. We're not sitting like some of the big tech companies who poured these billions. We need to have those diversified earnings, and we need to have a valuation that is actually quite reasonable and not like out there 100 to 1 or something like that. Because I think the counter to that is that notes do have a duration. They have a term. It can work for them and against them. But in terms of working for them, we've got a time limit. In terms of this note particularly is 4 years, but it can mature after 12 months and then quarterly thereafter. So there's lots of liquidity points of getting out. And we've got a deep protection level. So if there is volatility in these valuations of prices going up and down, going all over the place, and a sudden crash, we've got the capital protection built in, and we've got a duration of actually exiting at certain points along the line. So that's quite useful. And if I take the monetization gap, which is really revenues, how much revenue you're making, and the valuation, which is how much are you prepared to pay for this company, even though it's like sky high. Samsung this week produced its Q2 earnings. Absolutely sensational. We don't hold it in any of our portfolios. We haven't. But it's been absolutely sensational on the back of this latest trend in the last 18 months. It did 19-fold increase in terms of its revenue, 19 times. So if you're a business owner and you had to say to me, last quarter I did 19 times better than the previous quarter. I mean, that is stunning. And the numbers that these guys are producing are in the billions, okay, of dollars. Funny thing was, Samsung's, when it announced its earnings, Samsung's price went down. Why? It's counterintuitive. It doesn't make sense. Well, not really. The first part was that it has had an extraordinary run, and a lot of people took profits. Okay, they said, we're going to bank some of the profits. We're staying in here, but we're going to take some of the profits out. Well, it's good logic. It makes sense. The other one is that it comes back to this question of the elephant in the room in terms of, are things still hunky-dory and kosher in the world of AI? And I think what one has to, in as much as earnings have become and as revenue has become exceptional, so have valuations. And people are no longer trying to identify the winners of AI infrastructure. We all kind of know who they are. I think people are now increasingly asking how much of that victory, how much of that rise is already in the price. And what are we actually pricing in for the future, which hasn't actually been made. As I said earlier, a lot of this price is built on future expectations. And will that future deliver? So I'm calling it sort of AI indigestion a little bit. It's not going to slow down. All the big guys, Meta, Google, Microsoft, Tesla, SpaceX, you name it, to a man, Samsung, TK, ASML, TSMC, NVIDIA, they're all pouring more and more money. They've pledged. So it's not going to fizzle and go away, which gives me thought that this boom is going to continue for quite some time. Interest rates obviously are a problem, because if you're sitting on a lot of debt, and some of these companies now are raising bonds and they're trying to get money from the market, they're not sitting on their cash pile. They've denuded their war chest a bit, which is, I always say, like, keep something in the war chest for all times. Certainly high interest rates can hurt it. The three companies we've looked at, and we're going to dive into one specifically, because a lot of people say, why on earth have you got a cell phone company in there? Okay, so we're going to deal with that. But that's Nokia, okay, in Finland. The counter to that is that I look at something called cash flow. So when I do a deep dive analysis of a company, one of the things we look at is free cash flow. So that's after all expenses, what's left, not profits. This is after everything's said and done. Everybody's being paid. They've all gone home and they're happy. Look at those numbers in the far bottom right-hand corner. Nokia's the smallest. It's only got 3.4 billion euro sitting in its operational account that it can allocate to whatever it wants to do, okay, without anything. Verizon in the States, $20 billion, and Cisco Systems, 14. So these are companies with fat piles of cash that they're sitting on. So high interest rates aren't really going to hurt them. And the only reason I mention that is that there's been a lot of talk about maybe interest rates are going to move up in the States particularly. And globally, we have seen it settled. And people are concerned, mainly brought around by the energy shocks coming out of the Middle East and so forth. So let's have a look at quickly the three companies and the issuer. BBVA is a large Spanish investment bank.
It's global. Have a look at the three companies that are foundational to this note, because I'm liking it, Karen.
Okay. It's the recording.
Okay.
Everybody's getting onto that subject now. It's Nokia, Verizon,
and Cisco Systems. I don't know who I'm talking to, but anyway. Okay, so BBVA is the issuing bank, one of the largest in Europe, and certainly in the world. We've had a lot of experience with them. They were very comfortable issuing this guarantee. Then we've got Nokia, which is a Finnish-based company. They are listed on the New York Stock Exchange. We had to wait for pricing because it comes out of the investment bank in New York. And obviously Friday, they celebrated their Independence Day before the 4th of July on Saturday. So Friday was off in the Isle of Man, where Graham is, had a bit of a holiday, the oldest living parliament in Europe or the world. So we've had to wait a bit, but it all came together on Monday night. And so Verizon and Cisco, which is also an American-based, a New York-based company. So in their rationale, which I put together with the team, it goes into a lot more detail about the companies in terms of their positioning, in terms of the history and stuff. And you can obviously do your own interrogation. What I'd like to do for purposes of tonight is to have a look at Nokia, because a couple of my clients in my family office said, hey, but this is a cell phone company. What's that got to do with AI backbone and routers and this, that, and the next thing? So if you go to the next slide, thanks, John. Nokia transition. I wasn't sure, as I said, this is quite a new field for me in terms of tech. And I said, Nokia to me was a cell phone company as well, but it actually started in about 1860 as a timber and pulp company in Finland. And because it had guys all over the forests, the various forests, they needed to get hold of them. They started with little walkie-talkies, and those walkie-talkies actually ultimately became cell phones. Their biggest competitor in Europe was Ericsson. Not a lot of people maybe realize this, but Nokia actually sold its cell phone business to Microsoft in 2014. Okay, so it's not a cell phone company. It was for many years, but in the 60s, in the last century, in the 1960s, it started getting into network building, into the infrastructure network building. So it's been in there for over 60, 70 years in this particular space. And certainly the one area that it's made this complete pivot away from a telecommunications company to an AI infrastructure, building the highway, building that road that the data has to travel down. So it's pretty much made that transition. It has some legacy revenues from its cell phone businesses and its towers and all the rest of it, but effectively it has moved strongly. And if you look at any graph of what it's done in the last 2 years, it's quite stunning in terms of the returns. I think it's 80-odd%. in the last trailing 12 months. So it's very much got involved with Europe. It's very much got involved with North America. It's very much got involved with defense, okay? Critical. That's something we've launched a couple of notes on, is the defense theme, in terms of Europe rearming and re-equipping, in terms of how the nature of war has changed. Certainly Ukraine has showed us that people marching towards each other doesn't exist anymore. It's now, it's in the AI space. You'll see a couple of names there. NVIDIA, there's a massive agreement with NVIDIA. There's ones with AWS, Amazon Web Services, that are providing all the networking for AWS. So they are very much embedded. So these are the sort of, if I can call them, these are the anecdotal examples I look for to say, where are the contracts that are going to drive the revenue? And where's that free cash going to come from? So these are very, very good sort of commercial examples of what these guys plan to do by 2030. We're sitting at 2026. It's a 4-year product. So I've had to literally transport 4 years ahead and literally do analysis on a 4-year period in terms of what is happening. And obviously anything could happen. NVIDIA might cut their umbilical tomorrow and say, hang on, we don't like you guys. We want to go with somebody else. It happens. But at the moment, you have to look at the narrative in terms of what we can see and does it work. Okay. I've mentioned the 6G a couple of times. Nobody in the world, if you go to the next slide, has 6G. It hasn't been implemented globally yet. The companies at the bottom of this particular slide are the leaders in patent filing. So in other words, Samsung, Nokia, not in any order there, but just certainly those 5 companies are the leaders in terms of patents that are being filed and basically registered. So 6G is really the holy grail of speed to overcome this latency issue of the speed of transfer of information. And that comes back to this whole thing about expectations. The human condition today is that we expect things to happen instantaneously. In the old days, if you had a problem with your financial advisor or your bank or whoever, your insurance company, you'd bang off a letter. Then email came along, you'd bang off an email, and you'd hope they'd bang off an email to head office and find out what the problem was, and then you get an email back. Now it almost has to be real time. Access the system, access the portal. What are my live valuations? Where's my cash? Why isn't it showing? The expectation level has risen dramatically. I don't see the human race going backwards to what I just described. It can only go forward, and it can only go forward with that backbone in place. So it's an underdeveloped area, and 6G is certainly the race is on for 6G at the moment. Nokia is probably with Samsung in the sort of pole position. If you take a sort of Formula One, they're on the front row, they're on the front grid. Ericsson, who's their biggest European competitor, and there's others, Huawei, Qualcomm in the States, etc. So this is a situation where, the cloud, 5G, fiber, and 6G, they're all going to complement each other. They're not going to cannibalize each other. It's going to be a case of offering certain things to different people, and it'll be monetized in terms of what are you prepared to pay for that speed. That's how the human condition is. It's like, I've got something. How important is you? How much you prepare to pay for it? It's unfortunately the avariciousness of humans, and that's capitalism, unfortunately. But they are expected to complement. And 2030 is quite a seminal date, because that is, if you look at the guidances out of, for example, Nokia, that is when they want to have 6G implemented and running, not just some design. Okay, they're far down the road already, but implemented and actually working. And if you look back at the tactical advantage of leverage, it's got quite a few government contracts, quite a few military contracts. That will give the military and that particular government a lot of leverage in terms of, okay, we can actually do things a lot quicker when we see what's going on, and our speed of real-time conversing is a lot quicker than perhaps the adversary that we might be facing. So this is actually a fundamental part of the revenues that are going to flow into these companies. The next slide is really just the strategic shift that I've spoken about, how Nokia transformed itself from a telecom hardware company into a high margin AI and cloud data center network. Its earnings have been stratospheric. I mean, 80%, 84%, I think, on a trailing year, 12-month period. is very profitable. But there are challenges. There are definitely challenges. I talk about government contracts very glibly, but one overlays that with how tariffs, if they ever get implemented, that on-off flip-flop tariff thing that Donald and the administration try and implement from time to time. How's that going to affect? What happens if the EU, for example, starts putting restrictions on particular parts of exportability of IP, the intellectual property behind their developments. But some of those key performances are very, very strong. And I always say to people, key performances are useful if one looks back and it's consistent. If Nokia had been an underperforming company for the last 24 months and suddenly had an hallelujah year, you've got to look beyond that. You've got to look, say, where have they come from? Is this just a blip? Is this like what the pandemic darlings became, where certain companies just shot the lights out because there was a structural change in terms of how they had to operate? And then once we went back to normality, things didn't work so well for those companies. So these are very, very strong. And the one on the right-hand side is something from an analytical point of view where I look from, is if you got 2.5 billion of earnings and you create 1.5 billion in free cash flow, that's a stunning conversion rate. You can do the percentages, but that's, you earn profit of 2 billion, and out of that you can bank 1.5 as, okay, this is our insurance policy of things. Something goes wrong with the EU or tariffs or something else happens, etc. So there's your 82% at the bottom. And I've put in the 1 month at minus 20% so far. People say, oh, that doesn't look so good. You can't go up forever. Look, we saw what happened to Samsung. This is a great opportunity. It's a little retracement. It's coming off its highs. We always look for that in the selection of our notes. Sometimes we buy shares. We look at shares. We don't buy them, I beg your pardon. We include shares in our portfolio that have got the stuffing knocked out of them, but they're great companies. It's a typical Warren Buffett approach where you say they've got great companies, great leadership, great opportunity, great contracts. They just need the macro environment or something to change, and they'll be off to the races, as Graham would say. This is a company that's done specifically well because of the trend it's riding in. And simply, I think there's been a lot of profit taking. People have said, well, I've done really, really well. I don't want to be greedy, and I'll take profit. A lot of what has happened to Samsung and some of these other AIs. So certainly, if you look at the projected guidance that the corporate execs give us, and it's something we look at very carefully, they beat their earnings by 281 million euros. Their baseline last year, 2 billion in profit. The contracts that they've got signed are looking exceptionally strong. And if I look at why, I think it's a timing perspective. And my first argument is never time the market. It's time in the market. It's an old investment mantra. And that's on the next slide. And I think it's my actual last slide. Is these are 4 very crucial areas that make up the revenues of the AI part of Nokia. And you can see there extensive contracts which are tied to massive revenue, which ultimately will turn into profit, which ultimately turn into that thing called free cash flow that I like extensively. So yeah, it's not a cell phone company. So I sent some of these images to my client, and I said, this is where these guys are involved. And these are not new. These are not suddenly that these are popped out of the woodwork since Russia invaded Ukraine. These have been implemented over some time. They've created traction. They've gained traction absolutely since 2022 when Russia did invade Ukraine, and everything sort of changed. And it's interesting, and I haven't gone into it tonight, but I wanted to choose sort of the depth and the angles and issues we look at from a subjective perspective and an objective perspective. And this is Nokia. But if I look at some of the other companies, the other 2 companies, we've got a lot of, yes.
Sorry, you asked me to remind you when it was 10 to 7?
It's 10 to 7 now. Okay. So exactly. I think I get very excited about this because read the rationale. It goes into a little bit of depth in terms of where companies not headed, but where's the theme, where the concept is headed. So with that, Have a look at the other companies as well. But I'm going to give it to Jill, who's saying, okay, why is a fixed interest note so good? Why? It's the most simplest of notes that we structure. So over to you, Jill.
Great. Well, thanks, Andrew. You did a lot of work considering you are not of the tech age.
Thank you.
Logan, you're up next time. So with a fixed income note, the underlying assets don't determine whether the quarterly coupon payments are going to be made. The coupons are paid each quarter throughout the life of the note, either until the note autocalls, which is an early maturity event, or if it reaches its full maturity date. The basket of the underlying stocks that Andrew's gone through is actually used only to test whether the conditions for an autocall has been met during the term of the investment, or if the note runs to maturity, whether the capital protection conditions have been satisfied or not. So those are the only two areas where we're going to be looking at those underlying stocks. In terms of the coupon, you will get that coupon every quarter regardless. So moving on to the terms of the actual note, the issuing bank, as Andrew mentioned, is BBVA. There are their ratings. The coupon fixed, again, it's 12.55% per annum in US dollars, guaranteed, and that is going to be paid out quarterly. The maximum term for this note is 4 years. Our reference basket, you've gone through that as well. And then the capital protection barrier is set at 55% on the very last day. It is a European style note, so it doesn't matter what those underlyings do throughout the term. It is only relevant at the very last observation if there isn't an order call regarding the capital protection. Your autocall trigger, that is that early maturity, is at 100%, and that window opens from 12 months. And what that means is that if those underlying stocks are at or above their start price from 12 months onwards at quarterly observations, it will autocall. Once it autocalls, the note closes, you receive your last coupon, and we're done. Availability is from now until the 23rd of July, subject to full allocation being taken up. A number of times throughout the last, in fact, quite a few of our last notes, closed earlier because they were fully subscribed, even taking up additional capacity issued by the investment bank. Something that we really love on our fact sheets is the important date schedule that gives you the exact observation date where they're going to measure those underlying stocks to their start prices. The payment dates listed are the dates that the funds will leave the investment bank, BBVA, and be sent through to your trading platform, and it'll reflect probably a day or two later. Your income coupon is there, it's static, which is 3.1375. We had to have all 4 digits there. That's the income that's going to be received. And in the order call trigger column, you can see your potential order calls only start from the 4th observation. And then at the very bottom, your final observation is that 55% European barrier, meaning that as long as your underlyings are at least 55% of their start price, you're going to receive all of your capital back. So that gives you a 45% leeway for those stocks to drop. So just quickly to run through in a graphic example, basically the note again has a maximum term of 16 quarters, which is 4 years. Your coupons are going to be paid automatically every quarter. On the strike date, the closing value of each of those underlying stocks is recorded. This becomes your start value, which is then used as that reference point for all future observations throughout the life of the note. From your 12-month observation date, the autocall feature becomes active, and then on each observation date from then on, the underlying basket's compared to its start value. If all of the underlying stocks are at their start price or above, your autocall conditions are met and the note's going to mature early. Investors are going to receive their capital back together with their final coupon payment, as I mentioned. If the autocall conditions aren't met, then the note's going to just simply continue to the next observation date where the same test is going to be repeated. This process is going to continue until either the note autocalls or it reaches that final observation date. If the note runs to the full term, the value of those underlying stocks is compared with your capital protection barrier, and then provided that that barrier hasn't been breached, you're going to receive 100% of your capital back. There we go. Okay, then just in our example here, so the note starts and the income coupons are paid every quarter. At 12 months, the autocall window opens. But in this example, the stocks are actually below the autocall trigger. So then the note's going to just continue on. At the same observation, if you have a look, one of the stocks is actually dropped below the capital protection barrier. But you don't need to worry, because this has no effect. The capital protection barrier is only relevant at the final observation. Then here we've got observation number 9, and the underlyings are at or above their start price, and the note autocalls maturing early. Your investors have received their final coupon plus their capital back, and the note closes. If the note hadn't autocalled at the 16th and final observation, as long as those underlyings are at or above their 55% start price, your full capital is going to still be returned. Plus, you will have received all 16 coupons over the term of the contract. So it's a really, really simple and straightforward thing when it comes to fixed income notes. And then questions, we've got quite a few new people on the session. So in order to invest in a note, we never touch any investors' funds. All you need is a suitable online trading platform, which is also called a custodial platform. We are completely agnostic. There is a list of popular options on our website if you don't have a platform, or else you can feel free to mail us for some help. Once you've decided that you do want to participate in the note, you need to let us know that you would like to invest, either by using the link in the chat or by email. And then what we'll do is send you the ISA number and the term sheet for you to instruct your platform. Once the note goes live, we send out a notification with the starting values of all the underlying stocks. And then again, after each observation, we send a mail through to keep you informed about what's happening with your investment. If you would like a refresher on structured notes and how they work, you just let us know. We're happy to provide any kind of training and support, because education is a very important part of what we do with our investor community. And then remember that the closing date for your funds to be cleared and your instruction to be issued to your trading platform is the 23rd of July. So you do need to get that all done. But it is, again, subject to there still being capacity available. So with that, I'm going to say thank you and open up for any questions. Let's just stop share. There we go. Great. So, question time.
I think, Joel, I'll just finish my my side of things. Graham, who's on the call, who's part of our structuring team, many of you will know him, made a comment that I thought was really interesting. He said when he locked down the 12.5%, he says, you know what? He says, Mobs, that's almost double what a blue chip high dividend yield portfolio will deliver in the US. Which I thought was quite interesting in terms of the type of return at 12.5. That's double what you're getting in a high dividend stock portfolio. And this is guaranteed. I mean, dividends aren't always guaranteed. I just thought it was quite a nice takeaway to say, well, I can bank 12.5% per annum without worrying about it. Thanks, Graham.
Pleasure.
Sorry, just one thing, Graham. In the chat, I see that you said that, just to confirm, Andrew's opening point, subscription ends Friday the 24th. We actually close out the 23rd so that you can have everything by the 24th.
Perfect. That's great. That'll certainly make the team in IDAD very happy. Definitely.
Yeah. We like to give ourselves some wiggle room.
No, that's perfect. And I think that obviously you've stressed the point that you guys as Cashbox have set your limits regarding the hedge, and we just have to manage that quite carefully because there is only the one currency, the dollars, and we'll work accordingly with you guys on that. But obviously you know what's happening at the coal face, so to speak. So yeah, perfect. Well done, guys.
Any questions from anybody?
Statement from my side, Andrew. So you've built a number of resource-based notes where we really focused on the picks and shovels as opposed to the commodities and the likes. And it strikes me that this is the picks and shovels of AI, right? It's the infrastructure to let it run.
Yeah, very much so. So what Chad's talking about when he's talking about picks and shovels, it's a famous sort of descriptor of how investments work. You can. So let's take a very simple example. The gold price last year went absolutely stratospheric. Everybody was like, wow, gold, let's invest in gold. How do you invest in gold? Well, you can invest in bullion itself. You can invest in coins, Kruger Rands in South Africa, etc., etc. But obviously one of the opportunities is that who digs the barbarous relic out of the ground? And that's mining companies. And what do mining companies need? They might need heavy earth moving equipment, etc. So hence, it's a very sort of visceral example of picks and shovels, earth moving equipment, companies that actually extract the gold out of the ground. So hence the sort of term picks and shovels. And this again is, it's sort of picks and shovels. I think the thing that struck me most when interrogating the thesis, the investment thesis of this, is that these other companies, these hyperscalers, as I mentioned, are pouring absolutely trillions, billions into the space. But it actually has to get up to us, we the consumer, and it needs these networks to actually make it available through either, as I said, 5G, 6G, the cloud, etc. And I think the artificial intelligence world is becoming part of our fabric, our social fabric, our cultural fabric, our every day-to-day part of our lives. Whether it's, as I mentioned earlier, some simple examples of catching a robotic car to your robotic surgery on your knee type of thing. It's got to have that live time, real time delivery. And these companies are absolutely intrinsic. They're one of the building blocks. It's, I suppose, a bit like DNA. You have to have the DNA of a body for the body to exist, etc. You break it down into its smallest components. So, and the amount of money that's been poured in and the commitment, I think that, which is really important, the guidance that these execs give their shareholders and the investing markets is that, and the big institutional investors, your Fidelity, Vanguards, companies of the world, these massive fund managers have embraced it. It's not going away. So if anything, this is going to be one of the sort of sub-trends that I think does really well. And for the new people on the note, we don't need these companies to go stratospheric. As long as they just have love above, 55% what they've started at, happy days, you'll earn 12.5%, more than a double-digit blue chip dividend portfolio in the US. And you'll have your capital back, and it's a fantastic opportunity in terms of those looking for predictable cash flow, because this is predictable. It's every quarter. What you've got to keep your eye on is, is it suitable that it's going to, the trend is going to still be with us in 4 years if it runs to that duration. But as Joel said, from 12 months onwards, if these companies do rise beyond their start price, unfortunately, the note will end. Your capital will be repaid, and let's say after 1 year, for example, if all three are above their start prices, it will end contractually. The bank will enforce its terms, and they'll say, thank you very much. Here's your $10,000 that you invested back, and you've earned 12.5%, which has been paid out to you. So that's the simple nature of these notes. They proved exceptionally popular. We had a brace of them, in fact, more than a brace. We probably had about 5 or 6 come out 2023, 24. Which were very, very popular. People plug them into their fixed income. It's almost like a sort of fixed term deposit on steroids, except you can't get 12.5% in US dollars in a fixed deposit, unfortunately.